Monday, Tuesday, now Thursday, really in a standstill, a bit of a choppy phase. Wednesday, the big gains. However, you'll find on a lot of the charts, particularly in the technology sector, showing a lot of renewed strength, right? We're in that sort of 4150 to 4200 range on the S&P. Is there enough gas to get us beyond that? Maybe driven by tech and consumer discretionary. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here in StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the best practices of technical analysis. I've had a lot of really fun conversations recently. Some of the guests coming through this show have been super enlightening. We recorded a little earlier today our latest episode of The Pitch, which is going to air tomorrow morning at 9 a.m. Eastern. Really cool discussion with John Kosar, Julius DeKempener, and Jeff Huge. Some really interesting ideas. I'll tease a couple of the names that we were throwing around there, but certainly a lot of things to talk about. One of my main takeaways from these recent conversations is this sort of this disagreement between the S&P, the NASDAQ facing key resistance levels. I would say S&P between 4150 and 4200 is a monster area of resistance. We have now stalled out as we have reached that area. And so far today, sort of hanging out a bit. Now, tomorrow we have an employment number, which I know a lot of investors are waiting to hear about. That could certainly and most likely will drive things going on Friday. Also, plenty of earnings to talk about. But at the end of the day, the individual charts of individual stocks have meaning. We're going to dig in today into market sentiment, but particularly in the technology sector. We'll look at some of the names that are making moves and draw your own conclusions about what that means for the larger market environment. We have great guests on the show, a number of really fun conversations this week. Next week, 3 power guests for you, I would say. On Tuesday, the 9th, we have Ari Wald from Oppenheimer from New York. On Wednesday, JC O'Hara from MKM Partners. And then on Thursday, Mark Newton from Fundstrat. So 3 New York-based technical analysts, each with broad institutional followings, with professional money managers. We get a little window of their time to hear what kind of things they are talking about with their institutional customers. I would encourage you to tune in to all of those. Also, as I mentioned, our latest episode of The Pitch airs tomorrow. We just recorded that a little earlier today. I had a lot of fun, a really interesting conversation with some fantastic ideas with explicit buy and sell points and ways to manage risk, stop losses, and all of that. Some really good discussion about how the methodology that each of them used to about it. Also, this week, we have released Larry Williams' latest market outlook, which aired on Monday. Just yesterday, we aired our mid-year market outlook called Charting the Second Half. There's a lot to review. All of that, by the way, is at StockChartsTV.com, and it is free. Let's continue on today's show with our market recap. As I mentioned, Monday, Tuesday, and now Thursday, very similar feel, almost a directionless feel. That's not true because the market can go 3 directions. We can go up, we can go down, we can go sideways. So chopping around and netting out to sort of an unchanged day is not by definition good or bad. It's more just that third direction of sideways. This is a market in equilibrium. This is a market basically saying we've reached the right point, an equilibrium of buyers and sellers, no one side really in control versus the other. And we wait to see which way we move next. It's all about a catalyst. So between earnings and economic data tomorrow morning, we'll probably get a good idea of where we're going to end this week. Now, having said that, the S&P really flat for the day, ending the day right around 4150, which is not too far below where we closed yesterday, around 4155. The NASDAQ composite up a little bit more, about 0.4%. The Dow down about 0.3%. So all netting out essentially to an unchanged read. The volatility picture continues to come down. So the VIX is now around 2150. We'll look at a chart of the VIX a little later in our segment, Getting Sentimental. We'll look at some other sentiment data, particularly survey data as well. It's kind of interesting. Interest rates, a lot of red here as rates came off today. So bonds, essentially flat using the TLT, but interest rates coming off a bit with 10-year yield down to 267. That's down from around 275 yesterday. Same with long bond yields and short-term yields as well. The dollar index weakening. And again, it's hard to imagine that the equity markets would have a significant rally without the dollar index significantly coming down, I would argue, or at the very least not going up anymore, right? That sort of long-term uptrend in the dollar has been one of the key themes in 2022. That changed about 4 to 6 weeks ago, and that's what has allowed the S&P and the Nasdaq to rally. We see a stronger dollar again. That brings that likelihood of upside for stocks into question. Not really happening today. It's actually down about 0.6% using the UUP. Gold up, one of the biggest gainers out of all the things we're going to look at. Gold, not been a lot of days where I've been able to have that sentence that I share with you, but that is the reality today. The GLD up 1.6%. It's so funny. I was writing a note for my premium members at Market Misbehavior earlier today, a bunch of stock picking screens and talking about some individual stock ideas. Gold stocks are so beaten down. The justification for buying something like Newmont or Royal Gold or any of those sort of beaten down mining names is just because they've gone down a lot, right? They're testing support, but nothing really on the chart showing broad appreciation. Having a decent day today, probably one of the better groups. I'm not sure. Yeah, top 5 groups out of 106 or so. So not bad, but still a lot to prove before those charts look anything other than still fairly distributive. Cryptocurrency is actually quite mixed, although Bitcoin and Ether, which are the two we track most often, weaker today by about 1.5%, that is. Ether down below 1,600 and Bitcoin just dipping below 22,500 as we're broadcasting the show here right after the close on a Thursday afternoon. Let's look at the daily chart of the S&P. And again, I think this blue shaded area is the level. This is where we should focus. This represents the high from June. This represents about a similar rally to what we saw in late March, represents similar momentum characteristics, similar breadth characteristics. There's so many comparisons between what's happening over the last 4 weeks and what happened from late February to late March. What happened in late March is that was about it. We stalled very quickly on one day trying to close above the highs from late January, early February, really. And then we rolled over and ended up making a new low for the year about 6 weeks later. That same playbook would mean we get to around 4,200 or so, and that would probably be it. And then we would roll down and make a new low. I don't know if that is the exact case we would see. I'm telling you, there are enough similarities with bear market rallies and what I'm seeing right now to think that there's a non-zero chance, a likely chance, a maybe more than 50% chance that is the environment that we're in. My conversations this week, like Jonathan Krinsky, come to mind, really focusing on that thesis. So if you missed that discussion, I would strongly recommend you check that one out. That was a lot of fun hearing his take and bringing some hard data to back up why that could be a likely scenario. On the other hand, when we're looking at a lot of individual names, there's a lot of strength out there. And this is what gives me confidence that we will at some point get above 4,200. I'm just not sure if today's the day. We're going to talk a little bit about technology stocks after the break. We have a segment called Sector Deep Dive. So I don't want to beat it too hard on Apple and the other technology names. We'll save that for later. But it's worth noting Apple has had a fantastic run. It's gotten above 150, which was the high from May. It's gotten above the 200-day moving average, the gap higher on earnings, sort of that exclamation point on that rally. Brief pullback, now continuing to move higher. Certainly setting the stage for further upside. Certainly could see that going back to 175, 180. And retesting those highs from earlier this year and really the late March rally, but also from late December, but overbought right now, right? So getting to that point where a lot of times you'd see a brief pullback. Does that line up with the S&P reaching this level of resistance? I would guess yes, and that's what tells me that while some of these charts are so attractive and have had these beautiful setups, they've had such a run, most likely you expect some mean reversion. Remember, in the short term, it's all about mean reversion. It's all about counter trend moves that move against the trend. So I could see at the very least a brief pullback. And that's why I'll be thinking on a chart like Apple, where would you see a pullback to that you would have confidence that trend is still constructive, right? At what point does it need to be more of a stop loss where you get out of things that really aren't working anymore? Just to finish off sector-wise, it was the FANG sectors at the top of the list here: tech, communication services, consumer discretionary. Industrial is not a bad day as well, but none of those up a ton, right? The best performing sector, the XOK, was up 0.5%. That was the best. On the downside, you had financials, healthcare, consumer staples all down on the day. The real weaker one, though, was energy. And this has been a fairly consistent theme here in recent days and recent weeks, is the weakness in energy. While I think the long-term thesis for commodities certainly makes sense, you are not seeing that play out with energy stocks. And since we won't be talking too much about energy after that, I'm looking at each of these names as I was scanning for stocks making new 3-month lows. Not a lot of energy, actually no energy names come up on the list. But it's worth noting that a lot of these are showing some short-term weakness. They certainly could get to the point where they're on the new 3-month lows list, but at this point, they're rolling over and nearing test of support. Something like Diamondback Energy, right? It seems more distributive, a breakdown of a moving average support, rallying, but now failing to regain the 50-day moving average, failing at the late June high, now heading back towards the lows. You'd want to see more improvement in there. And certainly when other sectors, like the growthy sector, is doing so much better, it makes those seem much less attractive. There are earnings in this space this week and not really getting any upside momentum boost from earnings. Oxy is another one. This is Occidental Petroleum. OXY, again, sort of heading back to previous lows. So this is the type of space that I would not be super confident in upside from here in the short term, certainly because of this distributive pattern. If you look at the chart of Oxy, it's really a head and shoulders pattern, right? I mean, you have the head, maybe a complex head and shoulders where you have a couple shoulders on each side, but a clear neckline of support, taking the April low and the June low. If you draw a trend line, we are right there. And this is after the RSI failed at 60. I think there's downside potential in that space that I would be concerned about. Let's take a quick commercial break. We'll be back with a deep dive into the technology sector. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. We have a lot of fun making this show. We have a great team behind the scenes making all of it happen and bringing some great guests along the way. Wanted to make a couple of quick announcements before we get to my next segment. First off, we welcome your questions. We had a great mailbag segment on Tuesday, some really thoughtful questions about how to navigate these markets. Keep the questions coming. We'll do another mailbag on Friday's show tomorrow. We'd love to feature your question live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. I mentioned earlier in today's show all the great special programming we've had recently. Martin Pring, Larry Williams, both with market outlooks. We did a mid-year market outlook called Charting the Second Half. We had 4 strategists each answer a series of questions looking forward through the remainder of this year. Our latest episode of The Pitch. There's so many great ideas and perspective to share with you to help educate, inspire, and inform you of how to manage your portfolio and your mental state in these sort of challenging markets. So go to StockChartsTV.com or on your mobile device to search for StockCharts TV on demand. Our next segment is called the Sector Deep Dive. This is really mirrors some of the exercises I used to do on the institutional side when I was at Fidelity. We would sort of dig into a particular sector. We had analysts that were focusing on particular sectors of the market and digging deep into a particular sector often surface a lot of insights and ideas that would not necessarily be as readily apparent if you're looking at kind of everything, which a lot of investors are. So what we like to do is focus on one particular sector and think about what that means. Today, we're going to talk about the technology sector. This is the top performer today. A couple of reasons to talk about technology. First off, if you think about Sam Stovall's traditional model of sector rotation, bear markets usually bottom with leadership and come out of the bottom with leadership from 2 particular sectors, consumer discretionary and technology, sort of the traditional offense. So let's look at the characteristics of this traditional offensive sector and see if we see enough to validate the fact that we are really exiting the bear market phase and into a new bull market phase. Other reasons is number 2. As I was doing a scan of new highs and new lows for my premium members earlier today, a lot of technology. I had about 275 stocks out of my large and mid cap US universe. And many of those, probably 20% of them, were in the technology sector, if not a little more. There were a ton of them. I actually ran out of room to write any of the utilities tickers down because it was all tech. So I want to talk a little bit about the construction of that sector, what it means, and what the charts may be saying. Here's a chart of the XLK, and that's often the first place we would want to look just to see the overall read on the sector. So what jumps out at me when I'm looking at the chart of the XLK? What jumps out at you? Let's look from top to bottom and look at each piece of evidence. First off, price. What is this doing relative to where we're at? The reason why the show, one of the reasons why the show is called The Final Bar, because I would always teach new analysts, look at the final bar, look at the current price bar, and then look to the left. Where are we at relative to where we've been? And if you do that, you can find breaking above this June high was pretty meaningful, right? I mean, this was a pretty significant move. So if we, and a lot of individual stocks obviously have done this as well. If you look at the charts of Apple, for example, have already broken above that swing high. The S&P is sort of testing that June high right now. The XOK has already powered through that, actually, and arguably broke above it, pulled back a bit, and now rotating and making a new swing high. The 200-day moving average is not far above where we're at. So we're sort of in the no man's land between the two moving averages. For me, a traditional bull market phase is the price is above two upward sloping moving averages. Traditional bear market phases were below two downward sloping moving averages. We're kind of in the middle in a bit of a transition here, which is similar to the transition you saw in the first quarter of this year, where we rotate within the moving averages. That's certainly a level to watch, around 151 currently on the XOK, to see if there's enough to get above there. That would certainly, elicit more optimism, I think. In terms of momentum, here's the risk to the technology trade. The fact that from mid-June to where we're at now, about 6 weeks later, we've had a pretty decent run. So the XOK has gone from 122.50 up to around 147, 148. It's a pretty big jump in a relative small period of time. It's about a 20-some% rally. Not bad off the lows. Now, again, we're still down for the year, so let's keep our eye on the ball there. But it's a nice run off of the lows. And again, similar in terms of the rally, it's gone up a little more in terms of a price basis to what we saw in March, which actually already eclipsed the bear market rally we saw there. Two other things to highlight. When I'm looking at the price trend, I can't help but notice this right here, which is a trend line using the highs, right? So if I take the high from December, if I take the high from March, you can see that lines up beautifully with where we're at right now. So when I talk about the market is at a critical juncture with the S&P, the NASDAQ hitting key resistance, things like the XOK are also hitting trendline resistance, right? We're attempting to get above that trend line, which would mean from a technical perspective, it would make a ton of sense for this to be the end of this move, and then we rotate back to the downside. That would make sense because that is a clearly defined trend line that lines up with the current level as we're becoming overbought. But what's most interesting to me, probably of all the things that we've talked about, is the fact that the relative strength is improving, right? And if you draw a trend line on the relative strength, you can see we've clearly broken that from a downtrend to really more of a market performer, a sideways trend in relative strength, to an improvement. If you look at the RRG, looking at the 11 S&P sectors, technology is one of the few sectors in the improving quadrant using the weekly data, meaning it's really starting to improve on a relative basis. And that is one of the key things to watch. As always, if you want to outperform the S&P 500, you need to own things that are outperforming the S&P. That's why it's an important thing to pay attention to. I feel like I'm doing the surface dive instead of the deep dive. So let's finish off this segment digging in a little bit. To do a deep dive on a sector, I like to use the industry summary function. If I click on table view, I can go down here to technology, and you can see these different groups. 3 groups that I would highlight for you that I'd encourage you to dig into. Renewable energy equipment has had a pretty good bounce. Things like Enphase, which was one of the 15 stocks that will be pitched in our latest episode of The Pitch, airing tomorrow at 9 a.m., is in that group. That's a lot of renewable energy, sort of clean energy, green names, hydrogen names, solar names, that kind of stuff. Plug Power is a pretty common name that's in that group as well. Second, semiconductors, and I'm impressed by the rally we've seen in semiconductors. The question is the longevity of it. The question is, can we sustain those advances? But if you look at a chart of the SMH, you can see that we've had this nice rotation to the upside. And then software, and it's worth noting that the XOK that we started with is really dominated by 2 stocks. Apple's about 24% of the XOK. Microsoft is about 22% of the XOK. So between those 2 stocks, you have about half of about 45%, 46% of the ETF. Everything else sort of is, NVIDIA is the next one, it's about 5%. And from there on, it's a bunch of single digit weighting. So it's really dominated by those 2 stocks. So when you look at the chart of the XOK and you think, wow, technology is doing well. Now, that's driven by the fact that Apple has regained its 50-day moving average and is moving higher. Microsoft, while not regaining its 200-day moving average, has eclipsed its May high or its June high, and they're both seeing a nice rotation to the upside. Just to finish off, this segment, I would say, with a lot of individual names. There's a lot of interesting names making new 3-month highs. If you scan for stocks making new swing highs just in technology, you'll find a bunch in semiconductors, things like KLAC that are getting above resistance, which again is impressive. They're all overbought right now. Many of them are, which is interesting. NVIDIA actually is really close to getting to a 3-month high, but not quite there. Similar to the S&P, it's kind of approaching a key level. So I need to see NVIDIA get above 200 to get really excited about it. Just to finish off, I mentioned software. So we mentioned Microsoft. Things like CRM or other names that I would be watching. CRM may be one of the more intriguing charts because it may be setting up for this beautiful rotation from distribution phase to consolidation phase or sideways phase to a new uptrend phase. It needs to get above 190, 195 really to get it above that June high. That would probably drive the momentum higher and certainly could improve the relative strength. Could be an interesting actionable point to see if CRM is able to improve from those levels. That's our segment. Sector deep dive. Again, there's so much to go into, and that is just a snapshot of the type of work that I would encourage you to do. And me and many others certainly provide services to try to provide that expertise and that analysis for you. Our next segment is Getting Sentimental. Thursday is a great day to review market sentiment indicators. A lot of them update on Wednesday and Thursday, so it's a really good time to sort of take a step back and see what we can see about sentiment indicators. My sentiment chart list that I'm going to be reviewing with you is part of the free chart pack that all of our members can access. If you go to your dashboard, go to all of your chart lists at the very bottom, there's a little gray button that says Manage Chart Packs. And if you click on that, you'll find one that says David Keller's Morning Coffee Routine. And it features this list of sentiment charts among with a bunch of other chart lists, many of which we feature on the show every week. We'll start with volatility. When we're looking at the VIX, again, as I've mentioned in previous discussions on sentiment, for me, it's all about volatility regimes. Volatility, the VIX in particular, tends to settle into a range for about 6 to 9 months, and then things change. And this is during the normal sort of rotation of thematic plays within the equity space. Certain things work for a while, and then we rotate to the next theme. And I think that's sort of what plays out with the VIX. If you look every 6 to 9 months or so, the whole range starts to fluctuate. The last 3 ranges have been late 2020 to early 2021, when we were sort of the 20 to 40 range. Then here in mid 2021, sort of the teens to 20s range, 15 to 25, we'll call it. And then since November of last year, we've really settled into a different range, about 20 to 35, essentially, as the overall range here. So in general, if you think about the peaks and valleys in price in 2022, it lines up pretty well with when the VIX gets above 30 or gets below 20. Those have tended to be some of those significant turning points. Now, the most recent high, notably, the VIX did not get as low. We actually stayed pretty elevated. VIX only got below 25. But right now, we're actually nearing the point where we were at the March peak and at the mid-February peak, as well as where we were really at the end of last year, although we got a little bit below 20 going into the new year. So the fact that we're getting back to those lows, again, lining up with, is this a bear market rally that is in its later stages? A chart like the VIX tells me that it lines up pretty well, right? The evidence lines up pretty well with these previous rallies that we've seen in 2022. What would tell me that this is different? Well, very simply, volatility would have to get low and stay low. Get below 20 and stay there. That's what we've not seen. When the volatility has gotten below 20, that's usually coincided with the market rallying enough that the next leg in the bear market can then continue, right? Because we're sort of calmed down, we're in a nice steady incline. That's when the next panic selling event starts to happen. The next catalyst comes to bear, and all of a sudden the market's rolling over a little bit. So we are reaching the same level of the VIX where we have topped out so far in 2022. I think that's an important chart to watch for that reason. The AAII survey is an interesting one. John Kosar earlier was talking about sentiment when we were recording the pitch. So that was an interesting point, just thinking about where we're at. And if you look, bullish sentiment hasn't changed a ton in the last couple of weeks, around 30% bulls. This is well below where we're at in a normal sort of traditional bull market phase, particularly a strong bull market phase. This tends to be the lower end of the range you've been. You often become well above that. But you'll notice if you look at mid-2020, the market actually recovered quite a bit, while the sentiment actually remained currently right about where it's been for the last 6 weeks or so, right? It hasn't gone much above there in 2020. There's a lot of disbelief as the market rallied more and more. That's something to watch for here, that, not necessarily have we seen a direct relationship at times with, a perfect contrary relationship, strong sentiment weak stocks or a bull market top, weak sentiment, and a bear market bottom. One of the things that I think is really interesting, though, as I was looking at this chart earlier today, if you look at the March rally, which is sort of right about here, look at the level of bullish sentiment, not far from where we're at. It was about 32, 33%, I think, bullish when we had that rally. So similar thing. But look at the difference in the bearish reading. Back here was only about 24% bears, right? So while we had a similar number of bulls, we had just a lot more neutral, a lot more undecided votes, and a lot less bears. It's actually one of the lowest bearish readings we'd had. The only other time we'd been that low was back in early November, late October, and that was just before the market essentially topped out. So the fact that we have a lot more bears right now tells me that there could be still more upside in terms of that, right? We've not gotten to that, sort of everyone's bulled up and no one's bearish. That's not the environment we see right now. So again, similar bullish reading, but much more in terms of a bearish vote now versus what we saw back in March. So a little different read in terms of, but as we've talked about for much of 2022, many more bears than bulls, and that continues to this day. Just to finish off very briefly, our discussion of sentiment here, the name exposure index popping a little bit higher to this week. It's around 55% equities. That's still underweight relative to sort of the normal value. The mean value is around 70 to 80% on this survey going back for years and years. So 55% still a little underweight. So even though we've had a nice rally and we came from around 20% to 55% positioning or exposure to equities, that's encouraging in terms of money managers taking some risk on, but not more than normal. We're still underweight according to that survey relative to where we've normally been. That is a wrap for the sector deep dive. We need to wrap this show, the Getting Sentimental segment. Let's focus on the 3 in 3. Here's 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. In our deep dive on the technology sector, one of the names we talked about among many was Microsoft. And again, what's encouraging to me is the strength of something like Microsoft getting above the high from earlier this year. But to add a couple components to the chart we showed earlier, trend line from the December high and the March high, similar to the XOK, we're kind of right there. Now, Microsoft has actually closed above it today, which I think is why it's an important chart to watch. And it's also a Fibonacci level. Take the high from November, the low from June. We've bounced off of 38.2% before breaking out. This could be a really ideal breakout point for Microsoft. What's the upside from there? In the short term, the 200-day around 294, but probably upside to the March high, which would take us to a 61.8% retracement. That's around the 307 to 315 range. So decent upside if we can hold this breakout. It's not overbought yet, which is different from some of the other stocks in the sector like Apple and others, which actually already have become overbought. Second chart would be the VIX. We talked in our segment on volatility or on sentiment. We talked about volatility among others. The VIX is nearing a low level similar to where we were in the March low and also where we were at the March high, the February market high, and the January market high. So it's worth noting that we've had this calming of the market, this lessening of fear, which tends to coincide with market rallies. As the S&P is testing this key resistance, I can't help but note the volatility has come down to where we've topped out before as a market. What would change the picture here? The market breaks above 4,200 and the VIX gets low and stays low. That's how I'd be watching that chart. Finally, as I mentioned, I've teased the episode of The Pitch. It was a lot of fun, a really cool conversation with 3 really knowledgeable experts, John Kosar, Jeff Hughes, and Julius DeKempner. That airs tomorrow morning at 9 a.m. Eastern on StockCharts TV. One of the 15 names pitched was Dycom Industries, DY. That's a telecom equipment name in the technology sector. We did a deep dive on technology. This is a name we didn't talk about. Look at this beautiful head cup and handle pattern breaking out. Folks, that's a wrap for the show. I'm Dave Keller here at StockCharts.com. Have a great night. We will see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.